And I think, look, the small stocks are exciting. I get it. And
yeah, they are.
You want to, we try to make the distinction here between sort of what we call investing and speculating. Okay, speculating is fine.
Oh, totally fine.
And I think you can make some really huge returns in a short period of time if you sort of get in front of the trend.
Yep.
But I think even the people, we have them here, that take a look at these, they're not suggesting or themselves either putting like 100% of their net worth into these plays. I think the majority of people's portfolios here and what we put out is in some of these safer, dividend players. You can still, beat the market and do well, picking those, but there's kind of, there's these other like sort of moonshots as we call them.
Right.
You can make 10x in a very short period of time. Yep. So it seems to be that, you just want to make sure that you really aren't putting, all your money into these things and thinking that, and that's, I think, where we talk about the get rich quick, right?
Definitely. And I mean, every single editor here, I'm pretty sure every single person, who gives, I don't want to say gives investment because we don't give personalized investment advice, but every single editor here has, at least one quadruple digit gain. Some of us have multiple. But the thing is, it's kind of like, some people like to go to Vegas. Some people like to buy lottery tickets, and like you can win a lot of money in Vegas and, you can win a lot of money at the lottery. Somebody just won like the Mega Millions jackpot for like $1 billion or something. That's tons of money. But the thing is all of the other people who played didn't win. And like, look at the size of the casinos in Vegas. Look at how lavish the appointments are there. Like, you really think that they're not making money? You really think that everybody's winning when they go to Vegas? Like, they're not. And so, like, but that's okay, because like you can have fun. It's enjoyable. Some people like to go skydiving. Some people like to climb mountains. Those involve a lot of risk too. So it's okay to take some risk.
Yeah, and if you're comparing, taking a flyer on, a not unprofitable company that has a new technology, your odds are actually much higher in the market than it is at the craps table or, all that kind of stuff. So you have a little bit of that advantage in there. It's just, you don't just the same way, and some people do this, you don't take, your life savings and go to Vegas, you take a portion, hey,
if I'm come back with none of this, I'll still be happy.
I'm going to take $1,000. I'm going to play some games or whatever. If I lose it all, it doesn't affect me. I had a good time. If I win, then that's great, and it's a bonus. So the same sort of way, that's the same sort of, in my opinion, the way to look at some of these high flyers that we're looking at.
That's exactly how I set up my own investments. I've got my retirement account over here, and I contribute to it regularly, and, I invest in dividend-paying companies that grow their dividends. But I don't put any of those, speculative stocks in there because that's the money that I like. I got to have that, because I don't want to work forever. I love working, but, eventually I'm just not going to be able to. Or, AI is going to take my job from me, something like that. But, so like that money's over here. And then there's another account where, it's like extra money. It's like, this is sort of like fun money, like maybe, instead of going on an extra vacation this year, I take that $5,000 and I split it up amongst, 5 penny stocks that I think have really good potential, that I think are going to just like grow and become giants in the next few years. And but the thing is if I lose that $5,000, in the greater scheme of things, that's not that big of a deal.
Right.
In like the big lifetime picture, like, 5,000 would be nice to have, but that, 100,000, that 200,000, that retirement account, that's what I need to live off of.
Right. And that you only need one of those to take off to really have some outsized returns there. So, sort of, it's like, having a lottery ticket, I guess, you know what I mean? You only spend $1 or $10 or whatever the Powerball is, and you can make some outsized returns.
But it's better than a lottery ticket, right? Because, like, if your lottery ticket doesn't hit, you can't sell it back. right? But if after like a few years, your stock hasn't hit, well, you can sell it back, and you might have lost some money, but you lose all of it. And with the lottery ticket, you lost all of it.
Yeah, and it's finite. There's always a chance some of these plays can get picked back up and acquired and all that kind of stuff. So.
Oh yeah, definitely. I've seen. The market's cyclical, and right now we've. Before we were in one of these, low interest rate, basically zero interest rate, which is, a company sees that and they're like, why, free money? And that goes for institutional investors too. They're like, hey, wait, like I can borrow money and not pay interest on it? Oh man, like I'm going to put 10,000 of my own dollars in and $1 million a year.
Yeah, that's we've had this conversation around the office too about interest rates and savings accounts and stuff like that. So, going back to the dividends, how would Apple is now saying, hey, we'll give you 4.6%. A lot of these, like I just called my bank a couple of months ago and was just like, what's up? And they're like, oh, we have this new where it'll give you like 3.9. I probably, and that was a couple of months ago. Maybe it'd be higher now.
That's probably up to 4 something.
Yeah.
Now.
So these banks. So when you look at that. How does that affect the market in terms of trying to invest in a dividend stock or something income? Like, granted, that's still not beating inflation.
Right.
So, what effect does those interest rates kind of have on? It
definitely is tough on the income investments. Right. So utility stocks are, notorious dividend payers. They always call them like the best stocks for orphans and widows, because they're pretty steady. They don't really go up or down that much, but they steadily pay those dividends. So you get that income to pay your bills with. But the thing is, when a bank account is yielding 4% or, short-term treasuries, I think the 6-month treasuries are up around 5%, and there's literally no risk to those. You're guaranteed to get your money back from the bank. You're guaranteed to get your money back from the government.
Well, hopefully guaranteed.
Yeah, true.